Hi, folks. Welcome to this episode of Dalal Street to Wall Street. And with me today is Trideep Bhattacharya, President and CIO of Equities at Edelweiss Asset Management. Trideep, welcome. Lovely to have you.
Same here.
Let me start with your take on the market cycle that we're in today. And you've had a great career spanning many market cycles. When you look back and you look at what's happening today, how do you think this cycle is different or distinctive from other market cycles that have happened?
Sure. So thanks for having me on your show. I would say that I would characterize this cycle as different ripples, but underlying theme remaining the same. When I say different ripples, I particularly am amazed at the speed of market reaction to digest any new event or any new trend in the share prices, which something that used to take months to happen these days happens in days. And hence we as fund managers need to kind of adapt and react very quickly if one has to kind of take advantage of this anomalies as they arise. The second point that I would highlight in the way the markets operate today versus where it was earlier is the depth of it. If you look at, let's say, Indian market, in the one that we are operating right now, even if we go back to 2008 or years like these, an FII outflow would create significant amount of volatility in the markets. Okay. Today, though, FIIs have sold more than $10 billion over the last 12 months or so, and markets have actually gone up rather than gone down. A significant change in the way we treat our own equity asset base. It's the growth of Indian equities, it's the growth of Indian equities culture. But as I said, these are ripples on the surface. If you look at the underlying greed and fear, that I must admit has remained the same.
But because of this change in structure, it also means that the retail investor now has much more information at their fingertips. Information flows much more quickly. Social media, access to news, etc. Do you therefore think that volatility, right, is here to stay? Not the same kind of volatility, but a different kind of volatility where news and events, right, greed and fear get amplified. Absolutely. Because of retail investment.
And you put it nicely. This is exactly what I said, that because the flow of information is so quick and so transparent, makes it almost instantaneous, that the reaction in the markets, which used to take about a month or so to factor in, now takes a matter of few days. A classic example that I usually give in my talks is that if you look at, let's say, COVID-19, the India shut down, and on March 23rd, markets bottomed out within a week. Now, we are talking about a crisis of massive magnitude where the world hasn't seen. But within a week or so, the markets pretty much kind of factored majority of the impact of the event. So the reaction is quick, the information transmission is quick, and hence the depth of the market needed today is meaningfully higher than what it was earlier.
Yeah. So let's talk about another topic, right? We live in a interconnected world still, right? Though you have tariffs going up in certain countries, right? So the US has always had an impact on us, right? If you look at what's happening with tariffs and the Trump administration's focus on driving tariffs up, if you look at what's going to happen with the Fed, and though correlation with the US has gone down over time, right? It's come down significantly from a decade ago. How do you think this will impact our own domestic markets, and why do you think they'll react the way you're predicting?
So, in fact, I wrote a recent article on that, which is the end of unipolar world. Not that this will happen as of tomorrow, but over the next 10-15 years, the world that we have seen predominantly a unipolar, which is over the last 30, 40, 50 years from our college days, have been in and around the United States. I think that's probably likely to change over the next 10-15 years. And one of the reasons why it will change is, if you study the history of markets over the last 2,000 years, whenever a country's or an economy's spend to finance its own economic prosperity, in simple terms, the interest payments are higher than what the economy spends to maintain its global presence. And a proxy of that I would call is defense spend. Okay. Whenever the interest payments are higher than the defense spend over the last 2,000 years, if you look at history of economies and markets, you would see that, there is something called an imperial overstretch that happens, and essentially the economic power starts to lose its relevance. That's the essence of what I talk about. In the case of US today, the defense spend today is basically roughly about $988 billion, whereas the interest payments is north of $1 trillion. So we have now crossed that quiescent point where the interest payments, the cost of economic prosperity outweighs that of the global presence. And that's why you see a bit of a shrinking kind of, power base of United States. All in all, we're going to kind of, live in a multipolar world where currencies will kind of change in the way they kind of they are right now. The hegemony of dollar may be kind of gradually shrinking. Individual deals between or trade agreements between countries will actually take a lot of more precedence than what it were earlier, and hence the cost of doing business will actually stand to go up. From market standpoint, though, it is not all good news. Effectively, it will mean that across the globe, cost of capital will actually go up, and that usually means negative from market multiple standpoint.
Yeah. So let me debate that for a minute, right? Historically, there hasn't been a standard reserve currency, right? There's been a gold standard where no one's had the ability to print gold. The US still has the reserve currency stamp, right? And so in a world where the US dollar continues to be the reserve currency, right? And the Trump administration is only there for 3 years and not, doesn't continue for the next 10 years. Don't you think that the likelihood of it being a truly multipolar world shrinks?
The issue there is, though, the train, once it starts, does it stop is the question. So if the direction of the fundamental nature that I linked it to, which is the interest payments versus defense payments, if that kind of reverses materially, whether it is Trump or someone else, things will probably not go in that direction. So you are attributing this multipolar world transition to be a Trump issue. I am attributing this multipolar world issue to be a economic status where the interest payments being meaningfully higher than the defense spend and correlating with economic reality rather than trying to link it to one particular regime. And hence I think that unless this dynamic changes, where the debt of United States gets redeemed meaningfully and that number comes down, interest payments go far lesser, then sure, we will go back to US dominance. But if this dynamic doesn't change, then I think whether it is Trump or whosoever comes next, he will have to face with a similar reality, if not the same.
Got it. So let's come back to India, right? One of the sort of key underlying drivers you look at is consumption and what consumption does to the market, right? So let's talk a little bit about how you think consumption trends will affect different parts of the market and what your key thesis is and what does that mean for the retail investor, right? How should they factor this in?
So this has many kind of strands to this question. One is the near term and the second is the medium term. So in the near term, I would say that ducks are lining up for consumption as a sector. We actually, beginning of the year, called out consumption to be the dark horse of the current year. And things have actually added in favor of the consumption sector since time has passed, as we are now at the middle of the year. 2 or 3 things that I would point out. One is that while everything was negative on the geopolitical side, one positive bit was crude oil prices corrected close to 25% in this time frame. Second, inflation came down by almost 100 basis points on more during this time frame, which is certainly a boon for the rural consumer. Third, interest rates and liquidity environment has also eased over the same time frame. And finally, Honorable Finance Minister gave us a bonanza of close to about 5 to 7% effective salary increase for an urban consumer. Now, while all of these will gradually start to make an impact, as we get to the back half of fiscal year 26, I do see the disposable income at the hands of consumer improving materially versus what it was about a year ago. And hence, I think the days for consumer as a sector, which was languishing for a good while, will start to make a comeback. That's a near-term case. Over the medium-term case, I do think that the Indian consumer is still underlevered, underexposed to some of the global dynamics, and given that the demographic dividend is in our favor, I do see a structural case of consumption over a period of time as well.
Got it. So if you look at Indian consumers, right, historically they've had a propensity to save. Now, not necessarily in the best productive assets, but cash, gold, FDs, etc. As you think about consumption coming up, right, the other alternative is if I have more disposable income, do I invest in an asset, right? So obviously one asset is what we're talking about, which is markets. But the other asset that typically people use outside of cash and gold is a house, right? What do you think about the real estate cycle, and what gives you confidence in real estate today?
So I think, like a fundamental based fund manager, the first thing that we look at before we deep dive into anything is what's the inventory, right? And when we look at the inventory all across India of residential real estate, what we find that about a couple of years ago, it was a 12-year low, which is when we called out that real estate might be on a structural upmarket for the next 5 to 7 years. Since then, things have moved a little, and we are now at 7-year low, which is still good, but may not be as good as that in the past. But nevertheless, hence we are saying that we are in the middle of a 5 to 7 year upcycle in real estate. I do think that the story moves on from within the context of real estate from builders to the ancillary sectors, which I think will finally see better days ahead in the context of the broader real estate landscape. So yeah, we are positive on real estate as a landscape. Also, mind you, if we do anticipate a rate cut to happen in the back as we go towards the back of the year, this is one sector, given that it's a high value purchase, might actually see a little more benefit for the consumer than it was about a year ago.
Correct. So let's change topics, Trideep, right? We've talked about consumption, we've talked about real estate and credit. One of the bellwethers of our export economy has been IT services, right? If you go back, let's say 1.5 decades ago, they were the darlings of the stock markets. Everyone was in love with the stocks and they've fallen out of favor recently. You've taken, some would call a contrary opinion, saying, hey, there's lots of growth left, and these are stocks that one should look at. So can you help us understand what's underpinning your rationale, and how do you see this developing over the next year or so?
So let me rephrase what you said, and I would say that in IT services, it's an expectation game. As we headed into first week of April, where everybody was very negative on IT services, expectations were low, valuations were very reasonable, and we thought that overall, in terms of Trump regime, first instance, it may not have a significant impact on IT services, and hence, while we were negative heading into the first week of April, tactically we went overweight because we thought the expectations were fairly low, the valuations are quite reasonable. Even today, if you ask me, it's not that one is very gung-ho on the growth, but if I look at where the expectations are of the sector, I would say this is as worse as it gets.
So let's change topics a little bit again, right? So you talked about in your answer on IT services how you're looking at the fact that compared to expectations and valuations, you thought this was a quality pick, right? You talked about a key concept, quality, right? Because depending on the quality of the stock, which by the way is not a standard, right? It's not constant. Depends on the underlying fundamentals, depends on the current valuation, depends on expectations. So how would you think about quality? And most importantly, you're a sophisticated fund manager, right? What lessons can you give the retail investor that doesn't have the team, the experience and the assets that you have to also discern quality in the market?
In a very rudimentary way, quality is sustainable, and sustainable results over time is what quality in essence is all about, right? Many companies which were once quality are quality no more. But if you look at brands, if you look at companies globally which have stood the test of time and continue to deliver for decades after decades of double-digit growth, HDFC Bank being an example over the last 20-30 years, it's a kind of, it's something that people look up to. In a very simple terms, consistency of delivery is what I call as quality over a period of time. This, of course, comes from, very strong management, fundamental case of the business being strong, the moat around the business, and a whole bunch of other things which goes into making this happen. But if you were to talk about the outcome, this is what I would say: consistent delivery over time, of a consistent profitable delivery over a period of time, is what I would say. Now, from a market standpoint, which is the second strand of your question, people either focus on the quality or on the growth, and they both don't necessarily happen at the same place at the same time. So people who chase growth sometimes do a big compromise on quality, and what they tend to realize over time, that the growth what they thought would sustain did not sustain, and hence they lose money. People who are very hung up on quality ignore growth, and what they find is over a period of time this quality wanes because sustainable delivery of growth misses out. The holy grail of investing is balancing these two. So if I, let's say, call quality as a high PE stock, and basically when I say growth, I'm talking about earnings growth, balancing these two dynamics is what we as fund managers grapple with, and what we deal with on a day-on-day basis. That quiescent point, which is reasonable valuations, decent growth, and decent delivery over a period of time, if you can manage that, then that's the holy grail of superior performance versus average in as far as fund managers are concerned.
So if I'm a retail investor and I have a mid-cap stock that's delivering quality and growth, and a high market cap, well-known brand stock that's not doing that, you would say don't be fooled by the brand and what's sort of magic mirrors, but focus on the mid-cap stock that can actually give you those indicators.
Focus on earnings, basically. So my mantra, my investment mantra, if you call it, is follow the earnings, okay, and be in the queue, maybe slightly ahead of consensus, where earnings upgrades are likely to happen, where the company is about to deliver on earnings. That's all that matters. Over a period of time, if people don't like it, people will grow over a period of time to like it if the earnings delivery comes through. Sure. And that's where, whether it is mid cap, whether it is large cap, whether it is small cap, you would be surprised. People call it mid cap, but there are many leaders in the businesses which are leaders in their segments but are still a mid cap. So mid cap does not necessarily mean that it's a third or fourth, fifth company in that universe. Look at asset management companies. The largest listed asset management company, ladies and gentlemen, is a mid cap. It's the way we define mid cap. So the connotation brings to mind a certain say, okay, this is an also ran. Not true is my point.
Yeah, no, I agree with you. So let's talk about what's been a thread throughout this conversation, right? Indian market, we've discussed some market structure changes at the beginning of the conversation, right? What are the other market structure changes that you predict will happen over the next 2 to 3 years that investors should be cognizant of?
Right. So when we think about market structure changes, I think one of the from a 2 to 3 year perspective, one of the things that I would say that you're talking with regards to Indian market. Correct. Yeah. What Indian markets will actually go to see is first further more deepening of the local flows in the form of in the form of flow guide. I think one of the changes that we would see at the moment, if you look at or one of the big changes that I would like to call out is if you look at the market indices or composition of markets, it's heavily skewed towards one or two sectors, these historically have been fairly homogeneous, whether it's banks, financial services, or consumption. I think with the advent of new, smaller sectors and the high growth that they come about with, I do see a bit of a scattergram, the scatter around the sectors to kind of go up significantly in the listed space. What that means is essentially a country which was predominantly had an unorganized competition is ultimately getting organized or in the form of urbanization. And when that happens, companies tend to get listed. And as that happens, focus on a particular sectors or a few sectors changes to multiple sectors. And that, I think, opens up the investment avenues for investors and also makes the market more deep rooted, if you ask me. A classic example that I would tell you is something that has happened. Financial services about a decade or so ago used to be comprised of only 3 or 4 banks, and that's it. From there, we've had banks and insurance companies. From there, today, we have banks, insurance companies, AMCs, wealth management outfits, broking firms, and a few others. So, this is what I mean by broadening of market depth and broadening of listed universe. I certainly see this as a big structural change in the context of India.
Got it. Let's also talk a little bit about how you see political changes, both domestic and global, affect the market, right? What are your key risk factors that investors should watch out for, both local and global?
So my sense is that there is one big risk that we see right now. Of course, there are many, but one that is far from being factored, which is that if Trump or any of the global forces overdo this tariff drama, if I may call it that way, and hampers global trade more than what is warranted, we would have a severe recession globally. And the reason why that will happen so is essentially tariffs are completely anti-economics. So think about it. What we learned as the first principles of economics is we manufacture things where it can be manufactured at the lowest cost, and we sell them at a place where we can get the maximum bang for the buck. This is pure and simple capitalism. But what you are saying now in a tariff-led world, that I won't let that happen. Every country has a make in India or make in their own country version of protectionism going on. If that happens, then essentially inflation goes up materially, and we enter into a stagflationary environment if we overdo this. This is what I'm talking about. If that happens, then demand may not stack up as well, and you could see a stagflationary scenario in various different countries across the world, which will certainly not be favorable for equities. And that's one, as we go towards the back half of this year, or maybe in the next 12-15 months, that is one risk I don't think markets at the moment are sort of factoring in, and could certainly happen, and we need to be watchful about.
So if you come back to sort of what we've been discussing, which has been bubbling under, right? We've talked about the fact that more retail investors, whether it's India or US or Europe, retail investor participation has gone up significantly over the last decade. News availability, right? Information arbitrage is disappearing. Availability of news, the availability of news that's right as well as disinformation is going up, right? The ability to instantly trade. You don't have to call a broker, place a trade, he'll wait. It happens instantly, right? All of this means that, as we have been discussing, the positives get amplified, the negatives get amplified, the reaction time between events becomes that much less, which means your job as an asset manager is extremely hard, right? Where earlier you used to have a month to react, you now have a day, right? What is the role of technology in this, right? So people talk about AI, ML. At some point, right, I'm sure there's still the role of an asset manager to look at macro asset allocation, to think about portfolio choices. But in terms of day-to-day optimization, what do you think is technology's role, and how do you see asset managers adopting technology so that their retail investors get the best outcomes?
I'll tell you what we are doing. I certainly feel that technology is an extremely a good enhancer of productivity, and we certainly use so. Where earlier we would listen to earnings transcripts and take your own time over a couple of days to come to a conclusion, we now have softwares or effectively tools which can give you the summary and key points in a jiffy, and you know what to act on and what not to act on. So certainly kind of increases the speed that way. The second place overall is looking for certain data points across multiple sectors on certain factors, which we can very quickly glean through multitude of documents to get to what we are looking for, which is the insight. So effectively, there is a lot of knowledge. What we have to do is to glean through all of this to get insight. That journey from knowledge to insight is certainly kind of accelerated by the use of technology and AI and ML tools, and we certainly at our place are using them to our own benefit. It has reduced our decision making time and helped the quality of decision making. But having said that, when and there was a study done by one of the global broking houses, Bernstein, where one is the productivity enhancement part, and second is can they replace decision making. What they found is it's an extremely good productivity tool, but replacement of decision making, they are poor at that. So you still need the decision making to be there, but the help that you need certainly kind of comes quickly from that.
So let me pose a provocative question, right? Uh, as you know, I'm passionate about technology, right? I believe that there will be a set of completely technology driven funds, right? That will soon be coming into the market where, given the reaction time needed, right? Because look, you've talked about the move from 1 month to a week. That move will continue to become 1 week to a day to 2 hours. Now, at some point, it won't go into picoseconds, right? Because nothing happens there. So I see a future where essentially short-term traded funds, right, that have both long-short strategies will primarily become technology-driven, right? And for example, we ourselves are actually experimenting in it. What technology still hasn't solved is long funds, right? Because I don't think technology still has a handle on how do I take, many subjective sources of data and take a long bet over 3 years. Hard. Because the training data over 3 year cycle comes only once in 3 years.
So out of cycle data in statistics doesn't work.
Correct. So you'll soon have I think, a world where short-term trading outcomes, right, will be very technology-driven. Longer-term trading outcomes are likely to be much more human-driven.
Totally
And that
agree
will be
with you.
fascinating.
Totally agree with you. And in fact, I wouldn't be surprised you say that time will come. I think it is kind of getting there.
I also think it's here.
See, as long-term bets, essentially it's a time arbitrage. What may be a negative value today for the next 5 to 6 months, if I take a 3-year view, it may be positive value. And that's the call I am willing to take. So it's a time call which kind of works in my favor as long as the business kind of has certain characteristics. So you are absolutely spot on that from we run funds which we tell our investors that please come to us with at least 3 to 5 year horizon, and if investor sticks to that, there is certainly merit in being in them.
Thank you so much. It was fantastic having you today and getting your insights. Folks, hopefully this was insightful and you got to hear from Trideep how he views the market. If you have questions and comments, please do post them on the channel, and we look forward to bringing you another wonderful investment professional the next time round. Thank you. This is Subho signing off.